Welcome to Vetka's Finance, where we uncover the hidden stories behind money, markets, business, and the global economy.
Oh,
One simple explanation at a time.
right.
So, open your banking app right now. Just take a look at the balance on your screen. What if I told you that those digits aren't actually money you own, but, a digital ghost of someone else's debt?
It's a pretty unsettling thought when you really frame it that way.
It is. And today we are setting out to basically shatter this everyday illusion of what money actually is. We're going to take a deep dive, traveling all the way from the dusty plains of Mesopotamia in 3000 BCE, right up to a highly secretive, really tense meeting at the Camp David presidential retreat in August of 1971.
Yeah, that 1971 weekend changed everything.
Exactly. And we're doing all of this to answer one very specific question for you. Where does money actually come from, and why is our global economy currently drowning in over $305 trillion of debt?
And to unpack a question of that magnitude, we really need a robust foundation of data. So we're pulling from a pretty revealing set of sources today.
Yeah, we got some heavy hitters.
We do. We have a 2014 report from the Bank of England detailing the actual mechanics of money creation, which, by the way, runs completely counter to standard economic textbooks. We're also cross-referencing that with macroeconomic data from the Japan Futures Research Center, some historical declassified accounts of the Nixon shock, and critical structural research from EUCLID on the inherent instability of debt-based money.
Which is a lot to cover.
It is, yeah. But together, these sources document this financial architecture that, most people interact with every single day, yet fundamentally misunderstand.
Right, so let's start by dismantling a myth that has been drilled into almost everyone. When you picture the invention of money, you probably imagine this standard evolutionary timeline, right? Ancient people bartering chickens for shoes, getting frustrated because, well, it's hard to make exact change with livestock.
Right, half a chicken doesn't really work as currency.
Exactly. So they invent coins. Then, eventually, someone didn't have enough coins, and debt was invented to cover the gap. The baseline assumption is always that money had to exist before you could borrow it.
But the archaeological and historical records completely flip that narrative. I mean, debt did not follow money. Debt came first.
Which just sounds backwards to how we think today.
It really does. But if you look at the earliest recorded economic transactions from ancient Mesopotamia, right around 3000 BCE, you don't find a single coin.
Not one.
Nope. Physical coinage wouldn't be invented for thousands of years. What archaeologists actually dig up are clay tablets recording debts. Farmers would borrow grain from temples or, wealthy landowners right before the spring planting.
Right.
And they would make a promise to repay that grain after the harvest. These tablets carried incredibly precise interest rates, too. Historically, we're talking about roughly 33% for grain loans and 20% for silver.
Wait, 33%.
Yeah.
So they were calculating compound interest on grain deliveries millennia before anyone ever held a physical piece of currency.
Precisely. And the rates even reflected the natural world, which is fascinating. Grain reproduces, right? You plant a seed, it grows into a stalk, so the interest rate was higher. Silver just sits there, so the rate was lower.
Wow. That's actually brilliant.
Yeah. And if you look further east to the ancient Indian concept of rina found in the Vedic texts around 1500 BCE, you realize debt wasn't just this cold transactional spreadsheet.
It meant something more.
Much more. Rina translates broadly to debt or obligation, but it carried profound social, ethical, and spiritual weight. You owed a debt to the gods, to your ancestors, to your community. Early debt was basically the connective tissue of human relationships. It was a recorded promise.
Hearing it described that way as a recorded promise, it completely changes the relationship between money and debt. We usually treat debt as a byproduct of money, like a shadow cast by a physical object.
Right.
But if debt came first, then the debt was the original object. The promise was the real thing. Money was merely invented later as a tool to measure the shadow.
That analogy tracks perfectly with the historical record. I mean, money was simply the yardstick invented to standardize and keep track of the promises human beings were already making to each other.
But the leap from a localized promise between a Mesopotamian farmer and a temple to the global banking system you and I use today, that is massive. And the sources suggest this ancient concept of the promise has been institutionalized in a way that directly contradicts how we are taught banks operate.
Yeah, the most pervasive financial myth in modern society is the concept of the bank as a simple intermediary.
Yeah.
Like, if you ask a random person on the street how a bank works, they will describe a storage facility.
Right, the big steel vault.
Exactly. They think a bank takes the savings deposited by person A, holds them in a vault, and then lends those exact same funds out to person B. It sounds logical, right?
It's what everyone is taught.
Right. But as the Bank of England made explicitly clear in their 2014 first quarter bulletin, that is a complete illusion. Commercial banks do not lend out existing deposits.
Okay, hang on. Let's walk through the actual mechanics of this because it sounds almost illegal on its face. If I walk into a bank tomorrow and get approved for a $300,000 mortgage to buy a house, you're telling me the bank doesn't check their vaults to see if they have $300,000 in other people's savings to give me.
They do not.
Then where do the funds come from?
They come from nowhere. Or, well, more accurately, they come from your signature.
My signature.
Yeah. When you sign that mortgage contract, you are making a legal promise to pay the bank. In accounting terms, you just gave the bank an asset. So to balance their books, the bank simply types $300,000 into your checking account. They create a matching liability.
So they literally just type the digits into existence on a computer screen.
Literally. Commercial banks create new money whenever they make a loan, just out of thin air. I mean, most of the money circulating in the global economy right now was not printed by a government mint. It is simply bank debt created at the exact microsecond a commercial loan was signed.
Let me make sure I'm getting this right. The money I use to buy groceries or pay my electricity bill, it's just a digital record of someone else taking out a loan.
Yes. And when someone pays off their loan, the money is literally destroyed. It is wiped off the bank's ledger. When someone takes out a new loan, new money is created.
Okay, well, this introduces a glaring problem then. If money is only born when a loan is made, I want to look closely at the math of the interest. Because the EUCLID research zeroes in on this exact moment of fractional reserve banking. And it highlights what looks like a massive structural trap.
It is absolutely a mathematical paradox. So let's stick with a simple example. A bank issues you a $100,000 loan at a 5% interest rate. When the banker hits enter, they create that $100,000 principal. Those digits drop into your account and enter the broader economy.
Right.
But the bank does not create the $5,000 you need to pay the interest. They only created the principal.
So the interest required to pay off the debt literally does not exist in the money supply.
It does not exist.
If the money doesn't exist, how do you pay the bank back?
You have to go out into the economy and capture it from someone else.
Wow, it's a giant game of musical chairs.
Exactly. Borrowers are forced into a zero-sum competition. You have to sell your labor or your goods to capture existing money from the system to pay off that uncreated interest. But because everyone is doing this simultaneously, someone is mathematically guaranteed to lose. There simply isn't enough money in existence to pay back all the principal plus all the compound interest.
Unless the banks create more loans.
That is the only way to keep the music playing. To prevent widespread systemic defaults, the system requires continuous credit expansion. New loans must constantly be issued just to inject enough new money into the economy to pay the interest on the old loans.
So it's an endless treadmill.
Yes, it inherently demands exponential perpetual debt growth. The system cannot stay flat. It must always expand.
For a long time, though, this balloon of exponential debt couldn't just expand infinitely, right?
Yeah.
There used to be a physical constraint on how much money could be typed into existence.
There was. And to understand why that constraint vanished, we have to look at the 1944 Bretton Woods Agreement. So in the aftermath of World War II, the Allied nations needed to rebuild the global financial system. They centered it around the US dollar, which was pegged to physical gold at a fixed rate of $35 an ounce.
Okay, so the dollar equals a set amount of gold.
Right. And the rest of the world then pegged their currencies to the dollar. This provided a rigid structural ceiling. A bank couldn't create infinite digital debt because ultimately foreign governments holding those dollars could demand physical gold from the United States Treasury in exchange for them.
But this setup created a massive geopolitical catch, didn't it? The Triffin dilemma.
Yes, named after economist Robert Triffin, who saw the flaw pretty early on. It's a paradox of success. After the war, Europe and Japan were rebuilding. To facilitate international trade and economic growth, the world desperately needed U.S. dollars. But the more dollars the United States printed and exported to feed global trade, the more paper claims there were on a finite, limited pile of American gold stored at Fort Knox.
Because you can't just print gold.
Exactly, you can't print gold. By the 1960s, the U.S. was aggressively printing dollars to fund ambitious domestic programs and, of course, the Vietnam War, and the mathematical reality became undeniable. There were vastly more dollars in circulation than there was gold to back them.
And other nations absolutely noticed the math didn't add up. France's president, Charles de Gaulle, was famously furious about this. He called it America's extortion of privilege.
Which is quite the phrase.
It is. From his perspective, the U.S. was getting a free ride printing paper dollars to buy real French goods, knowing full well they didn't have the gold to back it up. So he didn't just complain. He started physically loading U.S. dollars onto ships, sending them across the Atlantic and demanding American gold in return.
He really forced their hand. And as other nations saw France draining U.S. gold reserves, a bank run basically began on a sovereign level. By the summer of 1971, the pressure was critical. The United States was weeks away from completely running out of gold. So on Friday, August 13th, President Richard Nixon secretly ordered his top economic advisors to board helicopters for the Camp David presidential retreat.
Very cloak and dagger.
Extremely. 15 men were locked in a room for 3 days. They didn't warn any global allies. They didn't inform the press.
And the declassified accounts of that weekend paint an incredibly tense picture.
Yeah.
You have Treasury Secretary John Connally, a blunt political operator who basically saw this as a chance to flex American dominance. He wanted to break the gold standard aggressively and just force the rest of the world to deal with the fallout.
Right.
But pushing back against him was Federal Reserve Chairman Arthur Burns, who was terrified. Burns warned that removing the gold anchor would remove the very last structural constraint against government spending and runaway inflation.
And caught in the crossfire was Undersecretary for Monetary Affairs Paul Volcker, who was agonizing over how blindsiding our international allies would permanently damage global trust. But ultimately, Connally's aggressive stance won Nixon over. On Sunday evening, August 15th, Nixon preempted scheduled television programming. He went on national television and announced to the world that he was temporarily suspending the convertibility of the dollar into gold.
Temporarily.
Yeah, it was never reversed. When the currency markets in Tokyo opened the next morning, it was pure chaos. The Japanese yen, which had been fixed for decades, suddenly had to be floated against a dollar that had no physical backing. European finance ministers were scrambling. The defining anchor of the global economy was just gone.
Just picture a massive global fleet of ships, all tethered to a heavy anchor resting on the ocean floor. Over the course of one weekend, behind closed doors, a small group of men decided to just cut the anchor chain. The ships didn't instantly sink on Monday morning, but they were now drifting on an ocean of pure trust. There was no physical backing left for the money in your pocket.
And that transition from a physical reserve to a fiat currency, a currency backed by nothing but faith in the issuing government, it changed the trajectory of the modern world because it begs the question, what happens to a global economy over 50 years when you replace the physical limit of gold with the infinite elasticity of debt?
Well, you look at the data from the Japan Futures Research Center, compiled by Yoki Yamaguchi, and the consequences become glaringly visible.
Yeah, Yamaguchi's research offers the empirical proof of the money creation theory we discussed earlier. He analyzed data from 1945 to 2020. So, in economics, money is categorized by liquidity. M1 is your highly liquid money, cash, and checking accounts. M2 includes M1 plus less liquid assets like savings accounts and time deposits.
Okay, got it.
Yamaguchi's data shows that over 75 years, the total money stock M2 correlates perfectly on a one-to-one basis with total debts from banks. He proves that government debt directly creates M1, while private debt creates those time deposits. It isn't a theory. The graphs overlap flawlessly. Debt literally is money.
And because that anchor chain was cut in 1971, there is no ceiling on how much debt can be created, which explains the UCLID data. As of 2022, global debt reached $305 trillion. That is 349% of global GDP. We owe vastly more money than the entire planet produces in value.
And that ratio comes with a heavy societal cost. Jacques de Larosière, a former managing director of the International Monetary Fund, makes a compelling argument in the sources. He points out that severing the tie to gold and entering this era of easy, limitless credit did not actually usher in healthy, robust economic growth.
What did it do instead?
It brought what he calls the Great Western Slowdown. We have witnessed decades of weak industrial investment and falling productivity, all masked by a financial system utterly addicted to accommodative monetary policy, specifically quantitative easing.
Which we hear about all the time. We hear that term quantitative easing constantly in the news. But if you strip away the jargon, it is just central banks buying massive amounts of government bonds and financial assets to inject even more created money into the banking system, right? trying to keep interest rates artificially low so the debt balloon doesn't pop.
Exactly. And the authors Joel Kurtzman in The Death of Money and Paul Grignon in his research on money as debt detail how this fundamentally destabilized the system. Money morphed from a physical representation of value into a highly complex, unstable electronic valuation. Banks didn't just issue mortgages anymore, they securitized those debts.
Let's explain securitization for the listener, because this is exactly how the 2008 financial crisis happened.
Right, so securitization is essentially taking thousands of individual debts, like mortgages, bundling them together into one giant package, and selling pieces of that package to global investors as a financial product. It turned local debt into a globally traded commodity.
Sounds incredibly risky.
It is, because it separated the risk of a bad loan from the bank that originally made it, which encouraged reckless lending and amplified systemic fragility.
And this isn't just abstract macroeconomics happening in skyscrapers. This directly impacts your daily life. It explains why the gap between what you earn at your job and what a house costs keeps widening. If the system mathematically requires constant credit expansion just to pay the compounding interest, then banks have to constantly pump new money into the economy. That newly created money flows directly into assets, real estate, stock markets inflating their prices. Meanwhile, the purchasing power of your wages, which rely on the real physical economy of goods and services, continually erodes.
Yeah, that is the insidious nature of asset inflation, driven by credit expansion.
Right.
It enriches those who already hold assets and severely penalizes those trying to save their wages to buy in.
So if the math is absolute, if a debt-based, interest-bearing system is essentially an ever-expanding balloon nearing a breaking point of mathematical saturation, are we just trapped? I mean, the sources outline a few alternatives, but I want to look at how realistic they actually are. The first one proposed is sovereign, or debt-free money.
Sovereign money is an idea that actually gained major traction during the Great Depression, famously known as the Chicago Plan. The mechanics are simple but radical. Strip commercial banks of the power to create money.
Who creates it then?
In this model, only a central bank or a government can create money, and they spend it directly into the economy for public infrastructure or services, completely debt-free. It enters circulation without an attached compounding interest obligation. The money is a permanent asset, not a temporary liability.
But handing a government the unchecked power to print money directly into the economy carries massive inflation risks, which is exactly what Arthur Burns was terrified of at Camp David. So if changing who prints the money is too risky, is there a way to change how the interest works?
That leads to the second alternative. Interest-free systems, most prominently practiced in Islamic finance. In traditional Islamic banking, earning money purely from money compound interest is prohibited.
Okay, so how do they finance things?
Well, the creation of credit is tied directly to real physical economic activity through profit and loss sharing. If a bank wants to finance your business, they don't give you a loan at 5%, they take an equity stake. If the business fails, the bank shares the loss. It forces the financial sector to align its risks intimately with the productive, tangible economy rather than mathematically guaranteeing itself a return from thin air.
Okay, that makes sense. But if neither governments nor banks are willing to reform, the research from Not Bank points to a third alternative where people just quietly opt out.
We are seeing that play out in real time with the rise of digital assets and self-issued credit. Cryptocurrencies and algorithmic stablecoins are functioning as an escape valve. They offer individuals a mechanism to preserve value and transact across borders completely outside the traditional fractional reserve banking architecture. It is a decentralized attempt to recreate the rigid structural ceiling that gold used to provide, using mathematics and cryptography instead of a physical metal.
I have to push back here, though. These alternatives sound great in a vacuum. But we just established that in our current system, money and debt are the exact same thing. Paying off debt or drastically reducing borrowing literally destroys the money supply. Given that the global economy has $305 trillion of entrenched debt, can we actually transition to any of these alternatives without triggering a massive deflationary collapse?
That is the ultimate policy dilemma. You cannot simply flip a switch. Transitioning to a sovereign money system or unwinding the fractional reserve model would require structural demolition on an unprecedented scale. The global banking sector makes trillions of dollars off the current interest setup. They have every incentive to defend the status quo. Reforming this isn't about tweaking tax rates or adjusting Federal Reserve targets. It would require fundamentally rewiring the power dynamics of global wealth.
It's like trying to rebuild the engine on a commercial airliner while it's cruising at 35,000 feet. but it leaves us with a deeply unsettling reality to ponder. If our entire monetary system is built on fractional reserve lending, and that system relies on the mathematical necessity of endless exponential economic growth just to generate the currency needed to pay back compounding interest, what happens when that infinite financial math finally collides with the finite physical resources of our planet?
That is the question the current system is desperately trying to avoid answering.
If you enjoyed today's podcast, don't forget to like, share, and subscribe to Vedkis Finance. Turn on notifications so you never miss our next simple explanation about money, markets, business, and the global economy. Thank you for listening, and we'll see you in the next podcast.